everyone. It is May 14th. This is Market Insights with Mike. My name is Mike McCauley. I'm the Senior Investment Officer with First Option Bank. Assisting me is Mallory Vaughn. Mallory's our producer, editor, engineer, and tech person. And we're every Friday morning at 8 o'clock to talk to you about what we see in the market and what's happening and things that are affecting what we do. So a couple of weeks ago, we started talking about inflation. We actually started talking about it a couple of months ago when the Fed was outlining their plan on how to deal with inflation when it came. Because as you know, in any recession, inflation generally follows right afterwards. So it's something we've been prepared for. What we didn't expect for it to be such a headliner this week. So last week we had kind of a little thing on the difference between core inflation and the inflation you and I are used to. Our timing on that was pretty neat because coming out this week was Consumer Price Index, core inflation reports, and then of course all the media talking about inflation and how much of a problem it is now. So we're going to deal with that a little bit. Coming up. We're also going to talk about the market this week, specifically the Dow Jones average, which had, let's call it a volatile week. And yesterday we ended up 433 points. So, and it looks like we're going to end up on a good day today. So we're going to talk about that a little bit too. So let's get straight into it. And here we go with our first slide of the Consumer Price Index. Last week I talked about, when they talk about inflation, they're talking about core inflation. When you and I are concerned about it, we're more concerned about what's called the Consumer Price Index. So that number came out last week. It was 4.2% over April of 2000, the highest increase since 2008. The factors were the price of used cars, furniture, airline tickets. But to be honest with you, some of the factors had to do with the economy in April of 2020. Back then, we were still dealing with COVID. We were still seriously into a recession. So the fact that we have prices higher now than at the near depths of a recession is not that surprising. The 4.2% is high of an increase year over year. That number would be close to what I've used before, which is about 3, I think would be an acceptable number. And so 4.2% is a little shocking. I heard some reports this morning coming in, grocery stores talking about prices being up 20% on your food you buy. That doesn't surprise me too much. So that's what we're seeing. That's an area that you and I are concerned about is Consumer Price Index. And we'll see how that goes when it comes out next month and see if it adjusts down and aggregates down a little bit. That seems to be what the Fed thinks is going to happen, that we'll see a pop in inflation and then it'll aggregate back down to a normal rate. That's not an unrealistic viewpoint. So we'll see how that goes. Next. Slide is our U.S. inflation factors. I showed this last week. I've adapted a little bit because there has been some changes. The one on the far left, that bar is all items are at 4.2%. That's what you and I just talked about. And then you've got food up 2.4%. I honestly think that number is a little bit suspect, but and our numbers are kind of lagging on these reports. I think we'll see that pop up a little bit in the next couple of days or weeks. Energy being up 25.1%. That's not a surprise at all. Energy was definitely down in the doldrums in March and April. So the fact that it's up 25% is not a big shock. And then you have all items without food and energy. That means everybody except food and energy is up 3%. Boy, that's just about perfect. To see 3% growth year on year, that's kind of about what I think you need to have. And there's a lot of studies that talk about what's the ideal growth rate, what do we need, and we could get really deep into economical structure and what happens with 3% and why that's a good number. And we'll avoid that right now. But boy, if we could see the others balance out a little bit and that 3% stay there, that would be pretty good. So nothing really to be concerned yet other than, yeah, we're spending more money. But remember what we talked about before is 2020 is going to be a year that we study in economics. Our grandchildren, our great-grandchildren are going to study 2020 in economics. And the reason is that the culture of American society changes and will change in 2020, 2021, 2022 as we adapt. So you see, now we're going to talk about food prices for a second. And are those changing? Well, yeah, because the distribution of food, the purveyors had to change last spring on how they got their food to the consumers. We changed. We quit going to restaurants. Now they have to change a little bit on adapting again back to the pre-COVID system. Restaurants are opening again, about 50% capacity. So they need to start getting that food back. Whereas purveyors had started getting the food direct to the consumers because we're doing more on our grill than we are at our restaurant. So now we're getting back to more at our restaurants. So those things are going to change, and the economy is going to move around, and we'll have to kind of go with that and see how it goes. That's going to change for the next 18 to 24 months. So now we'll go to unemployment. Those claims, you can see May 13th was down to 473,000. We're really getting down there where we need to be. The moving average is dropping quite comfortably. And again, over and over, you've heard me say we need that number to be 200,000, 473. Considering where that's not bad. The part that we don't show in here is that the available jobs, is according to the Department of Labor this week, there are 8 million jobs available right now. That is an enormous number. So the problem is, do we get those people back to work? That's skilled labor, that's technical, that's support, that's professional. There's a lot of jobs in that 8 million. So when you look at this, and then you know that there's 8 million out there, you got to wonder how fast this line is going to fall and when it'll start falling. And I've said before, I think it'll start falling as summer hits us. And I still believe that as summer comes along, schools get out, I think that number is going to fall dramatically, that weekly unemployment claim. And we'll see how accurate I might be. Next. So our Dow Jones Industrial Average, yeah, it wasn't a fun week. You can see the aqua line took that big drop down there. But again, as I've said before, when you look at these, what you really want to do is look back at the forest and not the trees. Avoid making moves for one day. We sure had a lot of activity those 2 days where the market was down, with people calling saying, should I sell? But look back to where we were. This is a kind of a 52-week calendar going on. Look back to where we were 52 weeks ago, where we are today. So come back here to the far left side, come back over here to the far right-hand side, and you can see that the market's gone up. Have we had a couple of dips? Of course we have. That's the market. And remember, and when I come in the morning, if somebody says, what's the market going to do today? The answer is the market's going to fluctuate. So we're going to see that. So I don't think that, I think that we had a couple of bad days this week, but I also saw yesterday where we were up 433. Right now, the futures indicate we're going to be up 3 digits today. So that may have just been a fluke. And to some extent, I think it's a knee-jerk reaction to inflation. A lot of people saw inflation, they panic, but inflation is one factor in multiple factors. When we look ahead and see what's going to happen to the economy, inflation is just one of those plates spinning where we have about 20 we have to deal with. So we'll keep an eye on it, but we don't see anything that tells us to panic or tells us to make any moves other than what we're already doing. So this is the Dow Jones average and where we are, and we'll go on to the next one. Volatility Index. I've said before, and this just proves it more and more. It's kind of why I put it in red. This looks like a heartbeat. Is this a healthy patient? I don't know. Kind of. You got a couple of spikes, and you got a couple of small parts, and you got an average that's moving around a little bit, but not a whole lot. So to see volatility the first of the week over here on the far right-hand side, that coincides with the market having that big movement, and it's starting to come down again. The volatility index right now is it's 21. That's not terrible. It's not great. I'd like to see it below 10, but that's the volatility index, and it kind of coincides with market movement. What we look for there is any rise where we see it going consistently above about 28, 30, 32. That's where we start to look at the consumer view is starting to get a little panicky. So that's our index. Treasury yields, we saw a pop early in the week. They are starting to flatten out a little bit right now. The 10-year treasuries are 1.63. The spread is still great. If inflation is rearing its head, if inflation is going to be consistent, if inflation is going to be a constant and continue growing and not aggregate back, you will see that orange line start to slowly rise. And you'll probably see the blue line start to rise as well. And those will be slow movements. But right now, no big surprises. If you look at the day, yeah, you're surprised, but nothing to panic about. So this is our U.S. sectors for the week. Mallory had some color, which looks pretty cool. So you see that on the far left, you have this week, and on the second column, you have where we were last week. You see a little bit of movement, not a loss. Gas and energy is still leading the pack for 2021. Consumer goods is still at the bottom for 2021. And everybody in the middle, it's kind of like watching the Derby. Everybody in the middle is kind of jockeying for position. Basic materials, financials, just swap positions. Industrials are right there in line. Yeah, technology last week really fell. It's 5. This week it was number 9. So again, that reiterates what we had talked about, where we don't think technology can continue its 8-year run as leader of the pack. And so far, it's proving us right. The problem right now is chips that go into computers, cars, and a lot of other products and the availability there. So that is affecting the technology numbers. So that's our sector performance. World markets, and look at that second column from the right, and you can see that we had quite a few negatives and quite a few 0.04% for the week, 0.05, 0.5, 0.1. So not great numbers, but I still want you to look at the 2021 year to date. If these were nearly year-end numbers, it would still prove to be a pretty good year. You want to be at 10%, you're going to double your money every 7 years or so. So if you have a 10% annual return, that's pretty decent. So the fact over here, you see on the right-hand side that you've got 10.8, 10.6, 10.9, and then the 3 U.S. indices, Dow at 12 and the S&P 500 at 11.9. Those are actually pretty solid numbers for the middle of May. So the fact that we had kind of a blah week isn't too concerning. Obviously, we'll see how we follow it up next week. This is our calendar coming up. We have consumer sentiment coming out next week, business inventories. Those are all coming out today. Housing starts, and that I think is going to be a really important number. We had a big number in March, and let's see how it goes. We still have price of lumber is still outrageous. I had a friend of mine getting ready to build a deck, and he redid his budget because the weather's getting decent, and decided not to do it because the cost of his materials alone was going to be almost double what it was when his first budget 4 or 5 months ago. That does impact housing starts. We have the FOMC minutes. That takes me a couple of days to read because I can't sit down and read all in one thing. It's just too much to do. And we'll get through that on the 19th, 20th, 21st or so. The index of leading economic indicators comes out May 20th. And then May 31st, we're already talking about the Memorial Day holiday. Mallory and I are looking at taking off June and July, vacations, retooling, and some other things going on. We'll keep you posted on that. Other than that, let's remember that the movement in the market, those bad days, that's a tree in the forest. It's not something we're ignoring, but it is something we're working for a long-term return. We're looking at a lot of other things. It's not just inflation. And also remember that when you talk about inflation, you need to remember that if inflation is not going anywhere, then payroll is probably not going to go anywhere. So you have to take the good with the bad. I had a boss, Mike Conforti, a long time ago, who was a super guy. And he also always had a phrase. He said, you take the good with the bad. So when someone tells me that they used to get CDs at 17%, I know that they're talking about the Jimmy Carter era. And I also know that mortgages during that time were about 17%. So we have to look at everything holistically. Do we have inflation? Yeah, we have a little bit of it. Do we need it? Well, we kind of do. We kind of need some inflation. If you want to increase in your salary, you want to increase in income, you want your company to grow, you kind of need some inflation involved in there. So I don't want anybody to panic. Let's remember to step back and look at the forest rather than the trees. It looks like the Dow is going to recover a little bit from this week, and we'll keep an eye on it for you. We will see you 1 week from today, 8 o'clock in the morning on next Friday. If you have any questions, give us a call, 913-259-2110. Mallory, thanks for your help. We always appreciate you being here, and we'll see everybody next week. Thanks for joining us.